Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra and this is Market Today, a show where we'll help you understand the closing action on the day street. Well, it's Friday, the last day of the week, and it's panning out to be a pretty freaky Friday. You can actually see that the Sensex is down by over 600 points. The Nifty is also down by nearly 200 points. We have seen choppiness all the way long. In fact, we've given up most of the kind of moves that we had seen in the morning, and you can actually see most of the sectors have also slipped into the red. IT is the top drag right now, of course, led by the TCS numbers that came in disappointing and missed the street's estimates. That's dragged the index down by 1.7%. You have autos that are also driving in a slow lane, about 1.5% losses for that one too. You have oil and gas, realty, infra, broader markets, mid and small caps, consumer durables, and even the banking spaces that are all down in trade as well. Only pharma and FMCG, two of the defensive pockets that are still holding up to about 0.6-0.7% of move on the higher side. Even India VIX is up by nearly 1% at 11.7 odd levels. On the Nifty, when we see the top movers towards the closing hour, it's HUL, SBI Life Insurance, Axis Bank, Kotak Mahindra Bank, IndusInd Bank. So some of those private banks still holding up. Sun Pharma, Cipla from the pharma space also pulling up in trade. NTPC, ITC, Eternal as some of the other gainers. But so many as handful of gainers are still exiting on the Nifty, whereas on the downside, TCS is now slipped to the lowest stock in terms of the losses that we are seeing, a bit 3.3% of a cut on this one. Bajaj Auto, M&M, Wipro, these are all the stocks that are dragging in trade. In the F&O market, you have Glenmark Pharmaceuticals, that's up 14.5% higher, of course, led by the move that was seen on the back of $700 million of an oncology deal that the company subsidiary has signed. HUL also moving up on the back of enthusiasm of new management at the helm of affairs. You also have Irida that's down in trade by over 6%. Remember, the earnings have come in weak. We have also seen the asset quality concerns jumping. We have the management with us who seems confident of coming back after and getting all these things sorted in just about a quarter or two. But still, the stock is still reeling under pressure. You also have BSE stock down by over 4% in trade today as well. Let's also look at the broadest index and see what's happening there. Well, you have names like Segal India that are up 5.5% higher. Solara Active Pharma Sciences is up. You also have names like Phase 3, names like, for instance, NetWeb Technologies, Religare, Datamatics, GPT Healthcare. You also have names like Glenmark Pharma, we marked Soma Textiles, Lloyd Engineering. These are the pockets that are up in trade as far as the broadest index goes for trade right now. But clearly, the underperformance coming in from the broader markets and the IT space at this point. But rest of the pockets are still holding up. Let's actually pull up some of the other, index contributors that we can mark out for all of you at this point. So the market weakness is largely getting contributed by the heavyweights. Look at Reliance Industries. It's contributing about 30 odd points to the weakness in the markets today. But HDFC Bank is the top contributor on the downside. 35.5 points on the Nifty being contributed on the lower end by HDFC Bank. Then TCS is another one. 27 points being contributed from TCS on the lower end as far as the Nifty is concerned. Now, Bharti Airtel, M&M, Infosys, these are all the stocks that are contributing on the downward side. What's contributing on the positive side? It's HUL, and it's some of the private sector banks like Axis, Kotak. You also have Sun Pharma, SBI Life and ITC contributing slightly on the higher side as well. Let's welcome our guest on board. Mr. Kranthi Bathini joins in, Director of Research at WealthMills Securities. Warm welcome to you, Mr. Bathini, and good to have you with us on the program yet again. Well, first up, I want to understand from you, we were talking about some consolidation in the market playing out the last time you were with us on the channel. But what do you make of the extension of this weakness that we've seen in trade today? Does it have to get contributed to the TCS numbers largely? Is it something else that's also weighing on the sentiment, sir?
Hi, Sakshi. Good afternoon to you. Yes, the markets are still in a consolidation phase. Of course, we are not receiving any kind of strong positive momentum that can take the markets to new highs. One thing is the global environment is really what is certain in the global environment is the uncertain nature of these trade deals are concerned, that is has been creating some kind of uncertainty the global trade. It can be between US and Japan, US and China, who are the strong trading partners in Asian economy. That's where the worrisome is taking place at this point of time. And we started with a negative start with respect to the earnings season is concerned. The TCS results are not impressed, and also the guidance is looks very subdued at this point of time. That's what creating some kind of a extra caution at this point of time in the market. But the liquidity is quite strong on Indian markets, and we have both the domestic and foreign portfolio investors have been buying on Indian markets selectively. So one of the level to look in the medium to short term is it is psychological level also 25,000 Nifty. As long as we are holding this level of 25,000 level of Nifty, uh, the direction of the market medium to short term is positive. We can see some kind of aberrations here and there, but we need to closely observe the level of 25,000 level of Nifty. So
Okay.
we need to hold on to that level.
Okay, Mr. Bathini, what we'd been pointing out to all our viewers also, and in our discussion with all the experts, the matter with Jane Street that started off last week is probably again getting into focus, and that's why you can actually see the stock of Bombay Stock Exchange falling up to 4% in trade today. Now, what's happened is that there are reports that indicate that Sebi is now going to be expanding the probe into Jane Street into Sensex options as well. Remember, so far, the decision of Sebi in impounding some of the unlawful gains that Sebi marked out for Jane Street and banning Jane Street from the securities market came in from the 21 days of a study on the Nifty and the Nifty Bank options that they had studied. But now expanding the surveillance and probe to even Sensex options does bring in some kind of a volatility yet again, and therefore you saw Bombay Stock Exchange stock fall by about 4% in trade today. We are already looking at, Mr. Bathini, some volume clampdown after Jane Street has been banned from trading in the Indian stock markets and banned from the capital markets completely. We are seeing the volumes of NSE also climb down. The notional value loss has also been seen. How would you really look at in case Sebi is going to be probably taking this much further, continuing to find out, where else were some signs of manipulation seen in the markets and were other indices also compromised in certain way? How would you really look at the capital markets related stocks, exchange related stocks like BSE?
Sakshi, if you see the entire episode of Jane Street has been taking place from the past fortnight and all. It is there on the limelight. And with respect to the BSE stock is concerned, the stock has been a multi-bagger stock for every investor who have invested in the past 24 to 36 months. So any kind of these kind of major kind of a reaction, the news do comes, okay, that can inevitably create some kind of a knee-jerk kind of reaction. That's what we are witnessing in the BSE stock price is concerned. The primary objective of the regulator is to protect the uh, interest of the retail investors. That's what the regulator has been doing with respect to the Jane Street probe and also banning them into the derivative markets are concerned. By and large, in terms to answer your question, the impact of Jane Street on the volumes of the exchanges are concerned, it's going to have some kind of impact because these are they are the one of the large player in the market. So some kind of impact would be there in the medium to short term as the markets are currently going through a turbulent phase in terms of the global uncertainty with respect to the trade deals are concerned, and also as we are entering into the earnings season, so investors are trying to stay at a sidelines at this point of time. So some kind of a major impact is coming because of these macro news than the Jane Street news is concerned. That is the reason some kind of a subdued activity in the market and impact on the volumes. Once we get through the clear indications of these trade deals, and also once we kickstart into the earnings season. As the earnings season progresses well, we can see once the volatility that comes down in the market, we can see the volumes uh, bound to go up. But the kind of restrictions and uh, the regulatory measures to protect the interest of the investors, what the regulator is doing, okay, it is a welcoming move. End of the day, we know the data, okay, what kind of money the retail small investors are making in, especially in derivative market. That's where the regulator is much concerned. So it's going to have some kind of a medium to short term impact as the economy resumes its growth path. I'm sure the volumes are going to rise, and we are at a scratching phase with respect to the capital markets in India. Still, we just reached a range of 20 crores demat account. Demat accounts. There is a much more upside and new platforms and new apps, new broking companies are coming to democratize the capital markets in India. So the volumes are bound to go up on a longer term basis. These are the kind of a short-term blips on the market volumes are concerned.
Okay. And now, Mr. Bathini, within the capital markets, opportunities that exist, where are you more confident of? Are you looking at wealth management players? Are you looking at broking houses or exchange-related stocks? What looks good to you, especially now that we are heading into, some of the big IPOs also coming in probably this year for, players like NSDL that could be coming in much sooner, maybe by the end of July or August. And for NSE, last quarter of the current fiscal year is what is the big expectation there. How do you think that is going to change the dynamics of what the opportunities present themselves to retail investors? What are your top favorite stocks from this basket?
Sakshi, I can say with respect to the financial market, especially the market related, the capital market related stocks are concerned, there is an ample upside is there, but one need to also consider this is a cyclical kind of the business. Okay, sometimes there would be turbulent times, and also the global factors are by and large going to influence these stocks performance on a medium to short term basis. But since the financialization of assets are taking place in India right now, and we have witnessing a smartphone revolution, the digitalization is taking place. So many of these financial companies are going to get benefited. It can be the asset management companies or market infrastructure companies like MIS, the CDSL, and NSDL is going to get listed, and also the stock exchanges as a quasi regulators and also market infrastructures are concerned. These are whole host of and also broking companies. We have witnessed a Geo, Reliance Geo getting into um, Geo Financials getting into stock broking. So these are the newses that are coming. So there is a whole host of companies that are going to get benefited over a period of time. But one thing is what valuations we are buying, how we are buying this growth, what price we are paying is extremely important. I believe on a medium to longer term basis, all these host of companies are going to create uh, create wealth for the investor for a medium to longer term basis.
Okay, fair point. Mr. Bathini, help us understand when it comes to the earnings season. We started off by discussing TCS and IT, but overall earnings season, are you already penciling in where the outperformance could come in? Are you looking to play the earnings season by way of selecting certain sectors and stocks, sir?
Yes, actually, with respect to the stock selection in goes on, we are looking at the stocks like the DCP, defense, capital goods, and power. These are the stocks, the sectors. So these are the sectors we are looking, and also the consumer is the FMCG companies, consumption streams, and also banking and financial services. We have witnessed a rate cut and any dip in the stocks. The in these sectors, okay, can be warranted by in the medium to long term to cherry pick the stock. But we can expect some kind of a positive momentum from these sectors like the defense, capital goods, power, and also the consumption. These are the sectors we're actually tracking.
Okay, got that. Also, Mr. Bathini, wanted to ask you, we've been seeing the markets also turning defensive in the last couple of sessions when we've seen consolidation play out. FMCG plays and the stocks within this basket are coming back to the focus. Pharma stocks are coming back to focus as well. Do you think FMCG is a good hiding place in this time when the markets are either directionless or bound by a lot of uncertainty globally?
Sakshi, in the medium to short term, yes, you are absolutely correct. These are the places can be the hiding places. But if you observe the FMCG, thanks to this quarter pickup in the consumption, otherwise these stocks have been in a consolidation. The big names like HUL, Dabur, and different FMCG companies have been in a consolidation phase. Uh, but for investors, for a medium to longer term perspective, and if the investors' horizon is long term, and also if the investors have low risk appetite, these are the sectors in the FMCG one can pick up, but there is a lot of disruption also taking place in the FMCG consumption theme is concerned. In this listed space, there are some kind of a regional brands, local brands, and organic kind of a brands have been rising. The local domains have been going up. That's where the medium to short term their margins are getting impacted. But these companies carries a strong business model, and also their supply chains are unmatchable. So the large cap stocks in the FMCG they're going to thrive.
Okay, well, Mr. Bathini, we'll thank you then for your insights on the markets. Appreciate your time with us, and thank you so much for highlighting the key outlook on various sectors that we discussed.
Always my pleasure.
Thank you so much. All right, viewers, about 12 minutes to go before we shut shop for the day. It's a 200-point downtick on the Nifty even now. The weakness has persisted, and we are now at the day's low point as well. Let's now also welcome Mr. G. Chokkalingam, founder and MD of Equinomics Research, who's joining in on the program with us to help us understand what to make of the persistent weakness in the markets. Mr. Chokkalingam, when the recovery started in the markets and we started to see 25,600, kind of levels, it seemed that we were very, very close to hitting the all-time high levels, and probably the things are turning back into focus. Then comes a period of consolidation, of course, led by uncertainty on the tariff talk, and now the earnings season has kick-started on a rather tepid note, with TCS disappointing with their numbers, the first company that came out with the numbers today. How would you look at the current scenario, and what is your outlook, sir?
Yeah. Basically, three reasons are there for this sudden weakness. Uh, Starting with the Q1 results, and as you rightly said, TCS posted disappointing results. But of course, I have been saying on this channel also that we don't have much hope on large IT stocks. The wealth creation story is over. As far as the market is concerned, it is not expecting double-digit growth for Nifty Sensex stocks. It is expected to be poor single digit. That is one major reason, as we are moving closer to result season. From next week onwards, you will see a lot of results. So that is one fear in the minds of the people, investors. Second, Mr. Trump, as we all know, in the short term, his policy announcements are highly volatile, fluctuating. Again, the kind of statements coming are not conducive for Indian economy and market, since we are yet to sign the deal with US. So that is also causing uncertainty. Third, according to me, one of the most important reasons for this periodic weakness is that we had a all-time high record level of market cap in September 2024 at 485 lakh crore, or more than $5 trillion. And in February 2025, we hit a record low of 385 lakh crore, that is about 100 lakh crore, got evaporated, 100 lakh crore of market cap. And from there, till 3 days ago, our market recovered 75% of the value erosion, overall value erosion. Out of 100 lakh crore losses in February, we recovered 75 lakh crore. And in the process, a lot of small and mid-cap stocks, even the Nifty stocks, Sensex stocks, have recovered. In case of small and mid-cap stocks, they recovered even 30 to 40%. And that is a reason that, for this weakness, because Earlier, we saw promoters and the PE funds, many of them booking profits in the market. But after this solid recovery and near result season and volatile news from US, made even the retail investors to book profit in those stocks which have ran up, substantially from February bottom. So these are the three reasons, but I would suggest that short to medium term outlook is still robust. Only the risk point is we should not have any friction with the U.S. economy in terms of trade deal, and we should not have any retaliatory or any absolute steep hike in the duties on Indian goods and services by the U.S. Otherwise, we are set for a robust outlook for the market.
From within the earnings, sir, where are you keeping a keen eye out on? Any key sectors where you believe, we could actually see Q1 turn out to be an absolute outperforming space? Or do you think rather the whole, space in the markets is likely to just be a gradual improvement?
It would take at least 2 quarters for Sensex and Nifty stocks and sectors to come back to double-digit growth, unfortunately. Because whether you take FMCG or cement or IT services or automobile, we have already seen the industry business number which are in poor single-digit growth, either volume or in case of IT in terms of dollar exports. So it's very difficult to expect solid growth in the Sensex and Nifty earning, and therefore Sensex Nifty may not rise substantially. And very difficult to find, a couple of sectors which assure you solid double-digit growth within Sensex Nifty. So perhaps, some of the banks, telecom companies can post solid growth, double-digit growth, but otherwise the outlook is not that robust. So therefore, I have been saying that look at over 4,000 stocks in the small and mid-cap space. Yes, many of them have rallied, but there are many stocks which offer you deep values, unique growth stories, possible acquisitions, and some of the holding companies still having a high discount. So there are a lot of unique stories, and that to assure you, good. They promise you a lot of return. And added to that, now the investor base has breached 22 crore this week. And every week, even now, 6 to 7 lakh new investors are coming in to the market, and they are likely to put in maximum money in the small and mid cap. So the only risk is that you have to be very, very cautious on the valuation comfort zone, but opportunities here. But still, I would suggest as a part of my research equity strategy that put minimum 30 to 40% the Sensex and Nifty, though the return could be limited in the event of any adverse development from the US on India's exports, including services, then there would be a lot of risk to the overall market. And there, in such a possible, I'm not forecasting that at all, in any event of such possible scenario, the Sensex and Nifty would rescue in terms of risk mitigation, because the DIs would continue to buy Sensex and Nifty stock. That would give you a lot of stability to equity asset. So that's my informed view.
Okay. Before you joined in, we were speaking about the FMCG stocks and how this space has been a big laggard, but finally some momentum is coming back. We are looking at how players like HUL, ITC, Dabur, Marico, they're all coming back in flavor. But are you confident of this space moving structurally higher? Will it need much more steam and support to get the consumption theme going?
I doubt. I think once we see the results, whatever momentum we saw, that will fizzle out for FMCG. Because forget me as an analyst, a couple of industry veterans in the last 1 month or so, they themselves said it is going to take a lot of time for FMCG demand to revive, consumer demand. So I think it is not sustainable. There could be one or two exceptions, but the sector is likely to post poor single digit volume growth. So that's my view.
Okay. So what is your thought on the mid and the small caps right now? In the recent recovery in the markets up to 25,500 and beyond, we'd also seen, comparative performance coming in from even the mid and the small caps along with large caps. They were also trying to come back as well because they were also seeing a lot of beaten down moves of late. But are you confident of this space further having some upside, or do you think the valuations will again come into picture as a question mark?
Yeah, a very interesting question. One has to understand the truth that the small and mid cap space is the biggest in terms of the universe size. You have more than 4,000 stocks. So what happens? The index. If you look at the mid cap, small cap index, not to a large extent dependable to really perform in your portfolios, because the universe is so wide, and the valuation, if you look at the small and mid cap PE, trailing PE on BSE side, extremely stretched. But that doesn't mean that there are no opportunities in this space, what I call SMC space, small and mid cap, cap segment space. There are many stocks even today available at one-time book value, price to book value in the banking financial. There are many well-established stocks available at 16, 17 PE. So one has to have a bottom-up approach in the small and mid cap all the time, and there are opportunities. So yes, the index, small cap, mid cap index may not even beat possibly the Sensex and Nifty, but selective stock approach would definitely outperform, and that has been the case historically for decades. So that would continue. So ultimately, it boils down to the quality of the management, balance sheet, valuation, comfort, and durability of the business model. So if you are right on these four parameters, you are certain to make money. If not in 6 months, 1 year, definitely in 2 to 3 years time frame, you will make a lot of wealth, from this space.
Mr. Chokkalingam, we haven't asked you about, what's your thought about the recent Jane Street episode that occurred, and how Sebi really took a decision to impound the unlawful gains that they found and to ban the, hedge fund from operating in the in-stock markets. Everybody's talking about the losses in volumes because of an absence of such a large player in the F&O space. And what is your overall takeaway from this entire episode for retail investors at large?
Yes. So personally, I have not done a single trade deal in F&O in my career, either for myself or for my investors, because I have not come across anybody who made a lot of wealth in F&O. I know some of the brokers who made a lot of wealth in the F&O business by offering the platform to the retail investors. But I have not seen you, including the stalwarts, making enormous wealth from the F&O business, F&O investments. So that is one. And second, I do not understand, the technical aspect of this issue, but I definitely support, the regulatory move, because the regulator themselves have come out with a, research finding in the recent time. 80-90% of the investors, retail investors, don't make money. I think, we need to restrict, the freedom given to the retail investors, particularly the investors who do not have a professional qualification in, doing a risky bet, and that is very much needed, because as a student of economics, the stock market plays a crucial role in finding resources for economic development. Now people are losing money in the F&O, and people are bidding for OFS, which doesn't go for investment in the industrial economy. Rather, a lot of money goes to the promoters for unlocking value. It is not wrong, but in many cases, 100% of the money goes for the promoter. So these are the two areas. I definitely agree. The regulator should restrict, and investors. If I take a little freedom, I would say that avoid F&O unless you are a professional investor, unless you know how to hedge your portfolio. For speculative reason, avoid, because I will tell you one strong point. With my learning, sincere learning from 92. Fundamentals need not determine the stock prices in F&O segment. Fundamentals need not determine the stock prices F&O segment. I have seen many people losing money, forecasting very bad results. Bad results come, but the stock goes up in F&O. So the correlation is very, very weak. The strong financial performance and the strong movement of prices in F&O. So therefore, do thorough research and go for cash-based delivery, unless you are a professional, unless you want to hedge. You have the skill set to hedge your portfolio. You go for delivery-based, research-based stocks, and amazing. During Achat Mehta time, our entire market cap was less than 2 lakh crore, and today it is it is about 458 lakh crore.
Yes.
It was only less than 2 lakh crore. Forget that even 2000, if you take, our overall market cap was 7 to 8 lakh crore. So phenomenal wealth can be made, consistent wealth can be made if you go for research-based, delivery-based investments for a minimum investment horizon of 1 to 3 years. So for speculative bet, completely avoid F&O.
Completely avoid FNO. That's the
For
last
retail
word
investors,
that
for retail
for
investors.
retail investors. That's the last word coming in from Mr. Chokkalingam. With 3 decades and more of an experience in the stock markets, he clearly says that he's not even taken a single FNO trade, and that should be a sign enough that very very few people who have the expertise only should be really looking at as a hedge and not as something which will help you make quick buck. And that's where most of the retail investors are right now getting stuck. Thank you so much, Mr. Chokkalingam, for being with us on the program and helping us with all your insights. 205 points of a loss, viewers, on the Nifty, 25,149. So we've slipped below 25,150 mark, and we've ended near the low point of the day, 0.8% of a loss on the Nifty in trade after a whole lot of choppiness that we have seen in trade. Even the Sensex loses about 737 points. That's down by 0.9% in trade today. Losses largely led by the IT sector, autos, real estate, media, stocks, oil and gas, but only prevented by pharma and FMCG that were providing some kind of a hedge. HUL, SBI Life, Axis Bank within the banking space move up higher in trade. But we end the week on a low note. This week has been turning out to be a very, very consolidative, leading into some more volatility and weakness on Friday. Now let's keep an eye out on how globally the trade pans out. There's a record high move that continues on the US markets, but we'll have to keep an eye out on as to whether there is any more sign of tariff certainty when it comes to a deal with India, and of course how earnings season really pans out. Both of these key triggers will impact the markets next week as well. Stay tuned with us on Business Today Television as the coverage beyond stock markets continues from the world of business and finance.